Welcome to another episode of the Financial Armor Show. My name is Jose Rodriguez, investment advisor at Cooper Financial, and your host for today, alongside my co-host Tony Shore. How's it going, Tony?
Oh, you know what? It's so good. I'm great. If I was any better, my name would be Tyler Ellegard. Let's
Right.
let's put it that way. That's how good I'm doing today. I'm great. I'm gonna just kind of take a back seat on today's show because we've got a huge get once again on the show. Jose, you have friends in high places because you've got the
try.
portfolio manager from Gradient Investments sitting right here with us, and we're all in the same room today, right,
Yeah.
guys?
Yeah,
Yeah.
I made it out here for a couple of days. I actually got to speak with some advisors and train them up on some things with just letting them know what we're doing in our practice and how we're changing people's lives. So that was a great opportunity that Gradient got to give me. Um, Tony said, "Well, while you're here, let's record a podcast." So
Might
said,
as
"Yes,
well.
let's do it." So yes, we have Tyler Ellegard here, which is the portfolio manager, one of the portfolio managers here at Gradient Investments, and he manages a portfolio that is very near and dear to my heart, which is a digital discovery because I have a lot of my own money invested in this portfolio, and it has been doing very well. And I just wanted to bring him on to kind of let you brag on your own portfolio and also kind of what to expect next on the AI space, the semiconductor space, crypto space. It's I think there's a lot of very exciting things going on right
Yeah.
now. And even though we're 8 months into the year, I think there's still a lot left to go through in that kind of industry. So thanks for being here with us.
Yeah, absolutely. Thanks for having me on.
Yeah. So first, I want to give you some time to first explain what is this portfolio that I've been mentioning, this the digital discovery. What is it?
Yeah. So the digital discovery portfolio, the idea here is that we're investing in the value chain of the evolution of technology,
Mhm.
right? So, and what does that exactly mean? Well, we're not necessarily going out there on the crypto side and saying we should buy this coin, this coin, this coin, right? That's not where my expertise lies. My expertise lies in picking companies, doing fundamental research on companies. And so we are investing in the companies on the crypto side, on the AI side, that are creating the platforms, that are creating the infrastructure for crypto trading, for
Mhm.
AI, doing machine learning, doing the large language models, the companies that are actually utilizing AI. That's what we're investing in the portfolio. And so the pillars of the portfolio are going to change over time as
Mhm.
technology continues to evolve. So a good example of that is when we first launched this portfolio, the pillars were uh, blockchain, metaverse, cryptocurrencies, and NFTs,
Mhm.
right? Because NFTs at the time was, and I still think there's some use cases for them, but the investment purpose fell away a little bit.
Mhm.
So that obviously is no longer a pillar because it's not at the forefront of technology. It's not necessarily being utilized in real world use cases anymore
Mhm.
outside of digital art.
Mhm. Mhm.
So that's no longer a pillar. And so we've added AI, obviously, as that's become a big thing with the launch of ChatGPT back in 2023, which is so long ago to think about. Um, and then we've also recently added quantum computing as
Yes.
a pillar. And
Wow.
we can talk about that more too. But so the portfolio is really just trying to invest in the next steps of technology and try and be at the forefront of that as those technologies begin to have real world use cases, become utilized, and eventually take off into the mainstream.
Yeah. We're going to talk about quantum computer here in a little bit, but give us some history on since it started, because I think it started in late 2022.
Mm-hmm.
Um, so I guess let's use 2023. What it did in 2023,
Yep.
because that's actually what caught my attention. I was like, started looking at this. I was like, wow. So what did it do in 2023 and 2024? And so far, year to date, where are we at?
Yeah. So we launched it at the completely wrong time. So we launched October 1st of 2022. And then about 15, 16 days later, that was when FTX collapsed and the crypto space fell with it. So it was perfect timing on our our standpoint to launch it then. So the
Good time to buy.
Yeah, exactly. Thank you.
That's you got to buy low and sell high, my friends.
Yeah. So 2023, the portfolio was up 105%. Last year, the portfolio finished the year up 48%. This year so far, year to date, we're up about 31%. So I would call that good.
Yeah.
Because 2023, the S&P 500 was up 26%. 24, the S&P was up 25%. This year, we're up about 9-10% on the S&P.
And
over the S&P. Yeah.
And that's why, and I believe in this whole, the semiconductor. I happen to be very good friends with people that work in that space.
Okay.
So I just kind of see it really close. So that's where I'm more comfortable with myself. I'm also a young guy, so I'm willing to take a lot of risk because this is a very risky portfolio, right?
Yeah. So we measure things in standard deviation. So it's the probabilities of your returns being within this band for one standard deviation, this band for two, this band for three, right? That's kind of how we measure risk. So the S&P 500, the risk, call it the standard deviation, the risk of the S&P 500 is about 16.5%, right? So any given year, your return can be plus or minus 16.5% on the S&P 500. That's generally what it's plus or minus 8% is the average return for the S&P. So you can be plus or minus 16.5%
total. Yeah.
Above and below that 8%, right? So that's the risk, right? So the digital discovery portfolio since we launched is 48% standard deviation.
Wow. Okay. That's a big difference.
Our annualized return is about 48% since inception, right? So that's still really good, but that means you can be plus or minus 48%. And that's a 66% confidence
more to make,
level.
more to lose.
Yes.
Right.
Yeah.
Is what you're saying. Yeah.
It's
like 3 times more. It's more.
Exactly.
I guess that in other words, the way you can
3x the risk.
Yeah,
of the
3x
market.
the risk.
3 times the risk of the S&P.
Yeah.
Yeah.
So
that's your digital discovery portfolio at Gradient Investments.
Yeah,
that we're talking about, just to clarify.
The reason it's that risky is these technologies still are not mainstream, right? They're headlines, obviously, but it's not mainstream. We're not using cryptocurrencies in everyday transactions. We're not utilizing AI in everyday things.
It's not Amazon,
right?
it's not Google, it's not Apple, it's not 3M.
These technologies are still very, very new. Even though Bitcoin was initially launched in 2009, it's still, in terms of currency and money, it's still a very, very new thing, right? So these new technologies will have risk.
Yep.
And that's, we can diversify as much as we can within the bounds of the portfolio. But again, when you're investing in 5 new technologies, it's hard to get away from that risk.
Yeah.
Right.
And another thing that it's been at least Morgan Stanley has been talking about it in their research is that these companies that are in this space are, they need a lot of capital to function, and sometimes they need some help. So sometimes if they don't get the help, they can't do much. So that makes them more susceptible to, or volatile, I guess, because of that need. And especially if in the economic space where people are not very confident, there might not be more investment going through them. So they could drop very drastically, just overconfidence.
Well, you also think about the type of companies that are typically in these technologies. So AI is a little bit different. So I'll leave that one out for now, and we can circle back to it. But large companies aren't going to be willing to take a bet on these new technologies until they've been proven. Right. So the companies that you're going to be investing in traditionally are smaller, newer companies, have less access to capital. Right. So that's who you're investing in. And so, to your point, those are the companies that can have what I would call a blow up. Right. The company can blow up because they don't have the capital. If they aren't getting the revenues in the door from the product that they're investing in or creating, nobody's buying it or using the service. It's hard to service your debt. You can't continue to pay that. You can't continue to invest in your research and development, right? So that's where you get the company that blows up, right? Goes under, goes away, goes down in price significantly. Those are the companies that you have to invest in to get access to these newer technologies. AI is a little bit different. I'll circle back to that and just quickly talk about why. So AI requires a large amounts of capital because you have to be buying the semiconductor chips. You have to be investing in data centers. You have to be investing in people that understand the modeling of large language models and doing machine learning. There's Meta was in the news, Facebook Meta. They were in the news recently about paying their or poaching their top AI expert, and the pay package was about $200 million a year.
Oh, wow.
Right.
That's real money even to you, Tyler.
Yeah. So like these companies need to have the capital. And so that's why the big companies are able to invest in it. They've already been somewhat investing in it for years and years in the form of cloud-based services. So you've got Amazon, AWS, you've got Microsoft Azure, Google Cloud, right? So they've already been investing in. It was a easier pivot into AI for them.
Yeah.
And they were the only ones that had the capital to actually invest in this type of thing. So that's why it's a little bit different for AI. But,
Interesting. Well, I have a question.
Sure.
And this is probably not in the digital portfolio, but I wondered about because of AI, you mentioned chips, and we hear chips when it comes to phones, computers, AI, even automobiles nowadays. Everything's chips, and then chips and batteries. But the material used for those chips, is that something that is in the digital portfolio, or is that separate because that's more precious metals, or you know what I'm talking about? I don't know the names of them. I'm not a scientist, but I forget there's certain elements that are needed for chip manufacturing.
Yeah, absolutely. So we're not investing in the miners of those products.
You're not going to that stage of the beginning. You're further down the road from that where you're investing.
You got the manufacturing level.
There's different levels of semiconductor companies. I won't get into it, but I have this really interesting diagram that I'll send you and you can use if you want. But it shows the different companies that are in the different levels of the chip making. So we're investing in those companies, but we haven't, at least not yet. I'm not going to say I'll never do it because there always is. When you're managing a portfolio, there's always a derivative of something.
Sure.
Right.
Sure.
So like last year, a good example of that was a derivative of the AI play was buying utility companies. Right. You wouldn't just your sleepy utility company. Right. You just pay your gas bill, your electric bill. But those companies did very, very well last year because that was what I would call a derivative of the AI trade.
Sure.
And people trying to find value outside of just the Amazons, Microsofts, Nvidias, right? So that's the kind of stuff that we're looking at and trying to get in front of before obviously the run up happens.
Yeah, and I mean one of those companies that it probably we have some exposure in the digital discovery is TSMC, which is huge in Arizona. They just they got money from the CHIPS Act, and I think they just got done finishing up that fab that they were going to build from that, and then they're going to self-fund another one. My friend works for them and he was telling me about it, and that campus is starting to look like its own city. And it's insane.
Well, so if you think back to 2020, so TSMC back in 2020 really started doing this Arizona plant. So we can, I don't want to get into too much specifics on that, but if you think about what happened in 2020 and to your point, autos, right? This is a perfect example of this. We work with a lot of advisors out in Michigan, which is where Ford and GM have their plants. We couldn't get, because of the supply chain disruption from COVID, we couldn't get enough chips over here to put into cars.
Right.
And so if you went and drove through Detroit or outskirts of Detroit where the plants are, there was cars lined up along the street that were just waiting for semiconductor
parking
chips.
lots and vacant lots. They had to rent like tens of thousands
Yeah.
of
Wow.
vehicles just sitting there that couldn't be sold or shipped to dealers. That's why
Because they weren't able to finish them up.
Yeah.
Okay.
couldn't put
So-
the chips in. They couldn't get chips.
TSM decided to actually start building more plants here in the U.S. And then now with tariffs happening, or a potential 100% tariff on semiconductor chips, companies like TSMC, Taiwan Semi, are now committing more capital, because if you commit more capital to the U.S. when you're a semiconductor company to building more plants, you get an exemption from the potential 100% tariff that could be in effect, right? So Apple's doing the same thing. Broadcom, I haven't heard too much out of Broadcom, which is a sister-ish company to NVIDIA on their product. But yeah, I mean, and then also just the pure need for chips for data centers now. We just need to have more of that manufacturing.
There's a higher
here.
demand.
That's
Plus, there's
also
a push from the
growing.
government.
In Arizona, you would be driving in a neighborhood, and there would be a random data center too.
Mhm.
They happened to build one right next to my apartment last year, and I was
Oh,
like, oh,
really?
yeah. And it's just 1 month it looked like it was just nothing, and the next month it's just a big building.
Yeah. Yeah, it's just the pure demand, and it's not going to stop. I'll tell you that.
Right.
But TSMC
It's like a
is
train
also
rolling downhill at this point.
Yeah,
There's
so
no stopping. it.
TSMC is also a little bit of a different animal. They're about 42 or 45% of the global share of semiconductor manufacturing.
Mhm.
So like NVIDIA doesn't manufacture their chips.
My friend had to explain that to me too, and it was mind blowing. I didn't know that part.
Yeah. So Broadcom, which is another one, they're a different chip type. They're ASICs, not GPUs, but NVIDIA is just the designer of the chip, and then TSMC is the manufacturer of it. And then you can go down the line and say ASML is the lithography that's used to actually create the wafers that TSMC then goes and buys the lithography machine from ASML to
So
make
it breaks apart at a microscopic level almost.
Yes.
Well, yeah,
right?
and they all work with each other. Like and ASML people are working in TSMC fab at all times.
Yeah.
And I'll be hanging out with him and his friends, for example, and I just assume everyone works for TSMC. He's like, oh no, I do work there physically, but I don't work for them.
Yeah.
I work for ASML.
So that's what I'm talking about. There's different levels of the semiconductor chain that you can go down.
Sure. I didn't mean to get us off track.
No, it's I think it's all related, and it's very interesting because and especially on the data centers, I wanted to read a quote from the Morgan Stanley's head of corporate credit research, Andrew Sheets. He said that they think global data centers capacity is going to increase by a factor of 6 times. But also with the cost is going to go up by a lot. So like I said, it's a train going downhill, and everything is looking really good for the semiconductor AI space. So what share of the digital discovery is exposed to that part?
Well, so to that question, or that point that you made on that quote. So if you just look at the capital expenditures, so the cash that companies are going to be spending this year alone, and the only ones I'm talking about is Microsoft, Amazon, Meta, Google, and Apple. Guess how much in cash they are going to be investing? And it's not all AI, but majority of it is. Those companies alone, guess how much capex they're going to be spending this year?
$400 billion.
Yeah. $400 billion this year. And that's going to go up next year. It's going to go up the year after that. Right. And then you've got other companies that are doing the same thing. So to your question, though, the percentage of AI, so I kind of group it. Blockchain and crypto go together. Like,
right. But wouldn't you say that
you can't have blockchain without crypto, and you can't have crypto without blockchain?
But wouldn't you say that blockchain uses AI or semiconductors in a way too?
Yeah. Yeah. The computers. Yep.
Yeah.
So I break that out as a category, like companies that are blockchain / crypto. I group that into the cryptocurrency bucket. And then for like quantum computing, AI, and the metaverse, I group that into AI. So roughly 60% of the portfolio right now is AI oriented. and then the other 40% is crypto blockchain oriented.
Yeah, which in some ways it's still indirectly connected.
Yeah, I mean
Yeah.
they're all intertwined in
Right.
some
There's
fashion.
the infrastructure.
Yeah.
Yeah.
So there's blockchains that are using AI to create efficiencies within the blockchain. Metaverse runs on blockchain. Cryptocurrencies run on blockchain. You literally cannot have blockchain without cryptocurrency, because cryptocurrency, the miners, the cryptocurrency is the reward for keeping the network secure, basically, and creating the blocks on the chain. Quantum computing is not necessarily involved in that, but it
can in the future.
It can be.
It's definitely
So
going to be
it's all-
involved with AI.
Yes.
I'll tell you that.
So they're all somewhat intertwined, but that's kind of how I break out the portfolio.
So, and I guess we'll stay on that quantum. I think earlier this year, did you add quantum computing? I think
Yep.
it was earlier this year, right?
Yeah. So earlier this year, so I had more conviction in. So outside of just like the very large companies in the AI space. So like if you look at Nvidia's return, if you look at Amazon, Google last year and the year before that, the returns were stellar, right? But if you look at a lot of the other AI names in the AI space, the returns were not good.
Mm.
So I had more conviction in those names coming into this year that AI would actually be better than, or have better performance than, cryptocurrencies and blockchain companies. And so earlier this year, I made that switch where I added quantum computing, and actually allocated more towards AI companies than I did blockchain. So I took out of that crypto blockchain bucket and put more into the AI quantum computing bucket.
So now with Trump's AI action plan, and we have this perception of this the train going downhill, right? Everything's looking really good. How long is this? Well, first, how is this Trump AI action plan going to really affect everything, and how realistic is it really? And when is it? Is it always going to be this great?
Yeah, I mean, the action plan is working, right? There's a lot more crypto people, I guess I'll call them crypto. I don't know what to call besides crypto people, but
players
in
the game.
Yeah.
In the
So
crypto field.
there's more people that like crypto, believe in it in
Yeah.
higher places now, right? So more people are believing in it. We've actually just had the Genius Act come through Congress, which was actually probably a very good catalyst for the crypto space. The reason I say that is the Genius Act was geared towards stablecoins, which is the next evolution of cryptocurrencies. So I don't know. There's a lot of use cases for certain currency or cryptocurrencies. Bitcoin's just kind of like the digital gold of our age. But there's use cases for Ethereum. There's use cases for Solana, XRP. Like go down the line. There are true use cases, but the problem is they're so volatile, right? If you ever go on Coinbase and you pull up the top 10 coins on any given day, they're going to be up or down 5%. You can't have a currency that you use and transact in that goes up and down 5% in any given day, right?
In a day.
You don't
that's
know,
too much volatility.
you can't price anything.
No.
Right? So stablecoin solves that answer because cryptocurrencies truly are much more efficient than our current system, right? If you want to send maybe not for everyday use, but think about sending an international wire. It takes about a week. So you go to your bank to initiate the wire. They send it to another bank who then sends it to a converting international bank who then sends it across the border to then hold it and send it to the local or a regional bank who then sends it to the person's local bank, right? That's a lot of steps. Cryptocurrencies, you put your money into a stable coin, you send your money to what's called an on-ramp bank, I'll call it, or on-ramp platform. And then it gets sent to an off-ramp platform and then gets sent to the person's bank or account, whatever crypto account they have. And it takes about 30 minutes. Right? And then if you want to do like instantaneous, like if I want to send you money and I already have my money on a crypto platform, it's instantaneous. Right? So I can be sitting next to you and say, here's your money. and know that you actually received it. So there's a lot more efficiencies in stablecoins. And so I think that's going to be the future of, and you start talking about central bank digital currencies, it's going to be the same exact concept. So the use case for cryptocurrencies has gotten better because now we're actually going to be using them. And some countries are actually using central bank digital currencies now. US is researching it or in test phase, and Europe is in test phase as well. So cryptocurrencies are going to become the norm. The traditional US dollar is not going to go away, right? You can still use it, but the main form is going to be some type of digital currency. And the way that I look at it too, though, is most of the way that we transact today is digital anyways. So it may sound odd that we're going to be going away from the dollar, going to a different thing.
But how many people are paying for things in cash anymore? Period.
That's
so
what I
you're
mean. So,
already
like,
using digital currency.
Yeah. So it's
I mean,
like,
it's all in ones and zeros. I mean, when I buy something, I tap my card or my phone. There's no cash anywhere.
Exactly. So that's my point. Is we're already digital. It's just a different form of digital.
It's a more efficient digital,
and potentially more secure as well.
Okay.
So, yeah, I think so. The future of it, I think, I don't know that crypto prices can like 23 Bitcoin specifically, I think was up like 150% last year, 100%. Well, you're not going to continue to get that type of return. Like the digital discovery portfolio, investing in the value chain of cryptocurrencies and blockchain, you're not going to continue to see 150% annual returns, right? That the growth trajectory of those companies, revenue, everything, like law of large numbers, everything starts to slow.
Right. Plus, because it costs so much at some point to get in, it's going to slow down.
Exactly. But that's where hopefully, on the digital discovery portfolio side of things, hopefully we'll find new technologies to go into or newer companies to move into, right? We can invest that way. Yeah. But from the growth trajectory of the overall environment of cryptocurrencies, at some point you get to the law of large numbers and you have to slow. Or the potential returns have to slow as well.
But with AI, on the AI side, you've talked a lot about crypto there, but you really do believe in the AI side, and obviously there's a lot of growth potential there.
It seems like that there's more left to give.
Yeah.
And that's why I'm thinking, wow, it's almost concerning, but also exciting, but it's also with concern.
Yep.
That it just seems like there's just so much more, because it seems like in the last year or two, I mean, we use AI. I started to implement AI into my own life. And I have the AI glasses, and I took them to Spain, and they made my trip so much more enjoyable. Because Europe is a walkable city. I was listening to music without bothering anybody, without seeming like I'm wearing headphones. And if I just want to take a picture, just did that, and it worked.
Yeah, I mean the traditional, like real world use right now in AI, there needs to be so much infrastructure for AI, the continued investment to keep pushing the technology forward. We're in a phase what's called generative AI. You type a prompt in and it generates an answer. Generative AI. The next phase, and AI doesn't have the emotional intelligence of humans, right? The next phase of AI is artificial general intelligence, AGI. And that's still, I wouldn't say it's a long ways off, but I would say it's probably another 2, 3, 4 years away. But that's where these AI machines, bots, right? You're starting to hear more about robotics. Robotics is part of AI, where they'll have the emotional intelligence of human and be even smarter than humans. And then the next phase of that is artificial super intelligence, which is like above and beyond what we can even imagine.
And maybe developing quantum computing at that point.
Well, when you need quantum for that one?
Almost there. We're a few years away from quantum. So Microsoft created their quantum computing chip and it works. but from like an official like quantum computing computer that's used
Usable.
Yeah.
is still
You need to keep it
about
so cold.
2027, I think, is the expected
Sure.
launch date. So we're still a few years away, or a year and a half away, I guess,
Yeah.
from 2027. But we're getting closer on the quantum computing side.
Wow.
But that's also going to accelerate the path of artificial intelligence and the capabilities of what it can do.
Well, sure. Yeah.
It's like that movie with is it Megan Fox? Is that where she's a robot but she's a nanny and she cleans the house?
I don't know.
Oh yeah.
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 Have you seen
I know-
that?
I
Yeah.
haven't.
Yeah, it's creepy.
It is really
I
creepy.
think it's supposed to be a horror movie, actually.
It is. Yeah, it is.
But I mean, we could keep talking forever, but we're running out of time, and I really appreciate you coming on the show.
Absolutely.
Anything else you want to add?
Well, just overall in the markets, I know we're talking about the digital discovery portfolio, but and I know you've said you've made some adjustments this year, and it's still doing really well. And they always want us to say past performance doesn't guarantee
Exactly.
future results.
Yep.
But wow, that's quite a track record. But overall, with the markets and the tariffs, I mean, what do you think? Just looking at the rest of 2025 into next year, any thoughts before we go?
Markets. So our base case is that markets will still finish the year higher, regardless of what's happening in the economy. Right, we're starting to hear about some consumer weakness, or economic slowdown, I should say. And the reason for that is because of AI and the companies that are leading the charge on that. So consumers are feeling stretched. We're seeing that across the board. I mean, just look at some of your like Lululemons, your Nikes. Like, people aren't buying as much stuff. Restaurants, that's starting to slow down a little bit as well. But the companies leading the charge are the AI companies that make up the largest concentration in the S&P 500 right now.
Yeah.
So I think the top 10 names, which are mainly like your NVIDIA's, Microsoft's, right? There's JP Morgan's in there as well. But the top 10 names make up about 37% of the market right now.
Yeah.
And those are the names that are generally involved in AI that can continue driving the market forward, regardless of what's happening on the economic side. So we think the market can keep grinding higher. I think it's going to be choppy for the remainder of the year. I know it's kind of slowed down after that April drop.
Sure. Well, we've been this past week, we've hit record highs. I mean, we're almost to 6,500 on the Dow, right?
Yeah.
Yeah. Or I
So
mean, on the
S&P,
S&P.
yeah. So I mean, I think generally speaking, I think we'll be okay. And then for the digital discovery portfolio, I think, again, I try not to make calls on where the portfolio goes on any given month or quarter or year, because
it's long term.
The idea of this investing in these technologies, you have to look at it on a 2-3 year basis, because that's where the technology, it takes time for these technologies to make their way. And I know the last couple of years have been fantastic, but again, crypto or Bitcoin, just take Bitcoin, for example. I know we're running out of time, so I'll try and wrap this up, but Bitcoin over the last 7 years now, 5 times it's fallen by 50% or more. And to get back to even on a 50% drop, you need 100%.
Right.
Right. So that's a lot of volatility, right? So we can see that throughout these periods, right? There's cycles where people want to have risk, people don't. Cryptocurrencies are in favor, they're not. AI is in favor, it's not. Like earlier this year, DeepSeek came out, and all of a sudden you saw these big AI names fall pretty significantly. So there's going to be these waves, these bumps, or hills, or I won't call them mountains, but
hills and valleys. They're hills and valleys.
But you're going to see these. I mean, back in April, the portfolio was down. I think year to date performance through April, when the tariffs hit, I think the portfolio was down like 22%, and now we're up 30 on the year, right? So like, there's these periods where you're going to see the portfolio go down. But I try to look at it on a 2-3 year, these technologies on a 2 or 3 year investment case, rather than looking at it on a monthly, quarterly, even a 1 year.
Oh my gosh. Yeah.
So,
well, great show. Thank you so much, Tyler. Jose, a lot of great questions. A lot to think about with that digital discovery portfolio. I'm always fascinated. It's probably the most fascinating. We talk about we get tired of talking about Google or Meta or Apple.
Yeah.
I mean, we've talked about them for so many years. It's great to have fresh meat in the market, right?
Yeah.
Yeah, that's doing well. So I think that's great. Jose, why don't you let our listeners out there know how they can get a hold of you? And if our listeners have questions about this or other investments, you at Cooper Financial and your team there are great. And you have a direct line to the portfolio managers at places like Gradient Investments, Tyler Ellegard. So let our listeners know how to get a hold of you.
Yeah, if you want to reach out to us, our phone number is 888-390-5277. Or you can also reach out to us on our website, financialarmorshow.com or cooperfinancial.com.
All right, cooperfinancial.com or the financialarmorshow.com, right? Financialarmorshow.com. Check it out. A lot of great information there. Well, hey, great show. Tyler Ellegard,
Thanks for having
portfolio
me.
manager at Gradient Investments. Great to have you on the show today. And our host, Jose Rodriguez. That does it for today's episode of the Financial Armor Show.